Hey there. Haven't done a video in a while. I've been sick for over a week. Just an annoying thing that just makes it hard to talk and breathe sometimes and definitely sleep. But things are kind of crazy in the market right now. I just kind of wanted to talk about it. I definitely want to talk about housing prices. My thoughts about it. And it's really data based. I don't really care about people's opinions. Unless it's data based, then who cares? But I do want to talk about housing prices where I think it's happening based on data and opportunity. But first, definitely interest rates are a hot topic. They're been a little roller coaster lately. It's what is this? Today's Wednesday. Tomorrow they're releasing consumer price index figures. So inflation is the killer of mortgage bonds, and mortgage bonds are what rates are based off of. So I'd expect rates to come up a little bit more, and who knows, until the economy gets under control, which could be a while, rates could be going up. It's hard to believe how high they would go up, given that just a year ago we're in the threes, and the height of the pandemic, we had rates in the twos and 15-year loans with a one in front of it. But also 40 years ago, rates were in the double digits. People were, when there was a refinance boom, people refinanced from like 18 to like 12, and they were getting the deal of a lifetime. Can it get that high? I mean, I don't see why not. Why wouldn't it? And that brings up a lot of things like why? Why? Well, really inflation. Number one. And the bond investors, they're not getting a return on their money, and they're fearful that when there is inflation that they're losing money, right? Because the bond investors, it's as you know, mortgages are fixed for long term. So when you have a mortgage, when you're paying a mortgage, that's actually hedging yourself against inflation. So when inflation goes up and prices of things go up, your housing payment is going to stay the same, which is pretty nice. But on the other side, of other people on the other side of the coin who are the lenders or the investors in it, they're getting income from the bonds. So if they have a fixed income, like imagine a senior citizen on Social Security and the price of food doubles, people like that are the ones that have issues. So, unlike a senior citizen who's got a fixed income, the investors kind of pick and choose what they invest in and why, and that affects rates, right? So. Lender dependent. Sure, lenders can add their little margins to it. Some lenders are way more expensive than others. Some of them will add fees, things like that. But overall, we're all dependent on the market, right? So that's rates, right? So should that freak people out? If it's not affordable, yeah, for sure. Like if you're buying a house and you've been pre-approved for a while and you haven't found the house and rates are moving up, well, maybe that house now is not affordable anymore. And that would be an issue. And then you can't buy, you have to rent for a while, right? But that's also an issue, right? And the reason why is, and again, this is database. I'm not going to show charts right now, but if you follow me at all, I'm a big fan of Federal Reserve economic data, fred.stlouis.org, and you can see all this stuff. But if you look at charts, during recessions, during when there's, when housing crashes or whatever, when there's rising, the one thing that's constant is rents. Rents are going to steadily increase no matter what, right? The landlords are going to keep increasing the rent whenever they can, whenever the market bears it. And, people are not going to band together and protest rents overall because that's just not a thing that really happens nationwide. People have to live somewhere, I guess people can stop paying rent and protest, but I don't know. Good luck with that. So keeping in mind that rents are going to keep going up, and even though interest rates are going to keep going up, another chart I look at is home values. And even though there are dips, and the biggest dip 2008 was a housing crash, over time values are going to keep going up. That's just the chart. That's what they say. And will values crash like they did then? I don't think so at all. Way different things happened then that are going on now. It's not even a different world, not in the same world. Back then, the number one reason for this was a flood of houses on the market. People were buying houses without down payments, without the best credit scores, risky loans that adjusted right away, negative amortization loans, people that never should have qualified, and all of a sudden they get into trouble quickly. There's a recession that people lost their jobs, and so everyone's trying to sell their houses. It's not even just houses. I mean, I remember then there was like it was like the Wild West. Like there were all these condo conversions, and everyone rushing to buy apartment buildings and convert them to condos to sell them as residential units. So I mean that affected like Florida and Vegas, but nationwide, yeah, there was definitely a dip because there was a flood of houses on the market, and there wasn't a lot of lending sources, and people, during recession didn't really have income, and it was hard to get a job, things like that. So there was more homes than buyers, so that's why house values crashed. And around that time, what we don't have now, thankfully, is a ton of like people in pre-foreclosure status, people filing for bankruptcies, things like that. And overall, this is another fact. The average credit score back then of homeowners was a lot less than now. So compare a buyer then to a homeowner, average homeowner now, higher credit score. There are laws in place to make sure people can qualify for the mortgage. And if someone can't qualify for it, there's alternative products, but they require a significant amount of assets, right? You can't walk in with a handshake anymore. So the housing market now is way more stable because people were putting down payments, and even if they didn't put big down payments like VA or FHA, the credit scores are higher. They're qualifying for the income, and VA has always been great because they underwrite things a little more common sense wise, anyways. But overall, better credit scores, more equity, more stability. So housing's not going to crash because of that. Like there's not going to be a flood of houses in the market because people are not in trouble. Another reason why, which some people are talking about, is many people. Well, first off, I read a stat, I can't find it, but 45% of the homes in the country don't have a mortgage, right? Like almost half the homes are paid off, and I'd say a good portion of the remainder, don't know exactly, but if you imagine how busy the mortgage industry was in 2020, 2021, the rates were, like I said, 1, 2, 3. I mean, geez, that's ridiculous. Those people who have those mortgages now, and believe me, every loan officer in the country was busy as heck. Every lender staffed up like 3 or 4 times capacity, and some of them, did it too much, and that's why you're seeing layoffs and companies closing and consolidating now. But there was so much business just because of demand. The values were going up. There was a frenzy to buy a house because it was the right time. Rates were really low, so it's just like the perfect storm for a housing boom, pretty much. And builders, they weren't building homes fast enough. They were still the supply was low on the builder side. So think about more than almost half the homes don't have mortgages. So those people are selling when they have to. They don't have to sell, right? Or maybe they're rentals and they're never going to sell. Who knows? And another huge portion of the housing base in the country have ridiculously low interest rates that they're never going to see again. So if someone bought their house or refinanced their house into the 2s and 3s, maybe they're a first-time buyer, and that's what they were able to qualify for in an expensive neighborhood because rates finally came down from 5s to 3s. They could have plenty of equity right now, but where are they going to go? If they sell their house, if they don't have to sell, like why do people sell? Divorce, death, relocation from jobs, natural disasters, like pretty bad things. Like no one has to sell just because it's on a whim. Some people do sell on a whim, but financial decision going from a house, that they have a really low mortgage on, and even though they could sell and cash out some equity, and possibly even buying a less expensive part of the country with their equity, with the nice down payment, their interest rate is going to be 2-3 times higher than what they're having. So their mortgage, unless it's a fraction of their old mortgage balance, their payment's going to significantly increase. So I forgot the term. I think it's like housing lock, rate lock. I don't know. But there are people that are not going to sell and can't sell, right? So you're not going to see a flood of houses on the market because people don't have to sell. There's not risky loans, and people are in very nice spots. In fact, the percentage of people's mortgage housing payments to their debt right now is at I don't know if it's a historic, but it's a really, really low percentage. So families are pretty comfortable as far as housing debt. Now, there are definitely still people, sorry, I'm still sick and just a little drippy. There are people who, unfortunately have excessive debts, car payments, things like that. But, they're not going to sell their house to get out of a lease, right? So where does that leave us? Well, I mean, rates are going up, right? They're probably going to go up a little bit more, maybe a lot more, who knows? People have to live somewhere. You have to rent somewhere. And the rent's going to keep going up, right? So what are you going to do? Not buy a house? You're not going to buy a house? I mean, if it's affordable, like, why wouldn't you? Maybe it's not super comfortably affordable, but if you qualify for the loan, right? Why wouldn't you? Because factually your rent is going to go up. You can assume that rates will go up for a little bit, right? And it'll get more difficult to purchase a house, and you have to live somewhere. If the price of food increases, right? If you have money, you're still going to eat. You're not going to say, "I'm not going to eat for a couple months until the cost of corn drops," or if gasoline's expensive, I'm not going to go to work today because gas is too expensive. Yeah, I mean, you'll make do. You'll figure it out. I mean, some people don't. Unfortunately, there are people that are on the cusps. And when things get bad, they need assistance, and it's a different conversation. But for the most part, it may be difficult, but it may be time to say, I know the values of the homes everywhere are going to keep going up, forever. I'm not going to time it right. I mean, there will be times when they drop, but you're never going to time it right. The experts don't time it right. Why would you? And the rents are more stable, so you're going to live somewhere. You have to pay rent, housing somewhere. Maybe be uncomfortable for a little bit. Maybe get a house, maybe in a less expensive area, and ride it out. At least you'll have stability with your payment. You'll hedge yourself against inflation. You'll protect yourself from landlords gouging people when they can. Because when people stop buying houses, people are going to go live somewhere else and rent. So they know. So I like to focus on affordability. So in general, I don't care about rates. Like, loan officers, we don't really sell rates. The restaurants, they don't sell the price on the food; they sell the product. And for me, that's what I do. I help people get into homes, and I use mortgages as a tool to get people into home ownership, so they can lock in stability, take advantage of appreciation, take advantage of amortization, and build up wealth, for their kids, for future generations. So at no point is the number on the interest rate the factor. Just what's the monthly payment? What's my out of pocket? And no guarantees, but what comes up comes down. Rates will come down at some point, and that will be opportunities to refinance. And I'll be here. All my clients in the last year that are in 5, 6, and now 7. People with great credit now are quoting 6% with decent down payments. Even government loans, but and when the rates are down, I mean, I'm gonna be there ready to help them secure lower financing when the time is right. And there's no guarantee, so you have to make sure that what you get into is at least manageable and comfortable, and you're not putting yourself at risk. So, putting that all together, housing is the only stable thing that you're gonna do, right? Everything else is gonna fluctuate. But when you own a house, at least that's squared away. And again, just to summarize, because there's not a huge rush to sell, there's not a lot of people at risk, then they have to sell. Values are not going to drop like people are expecting. The value appreciation may slow down. There will be a point when if rates get too high that it's not affordable. Well, in that case, only the desperate sellers will be the ones really selling. But there will still be builders building. And there will be still migration to other parts of the country less expensive, especially now where people are doing this whole work from home thing that's been taken on for the last couple of years. But that's what I'm thinking, right? But on a positive note, I guess some of that's positive. I think now is a time for opportunity. I'm not one to quote people, and I'm not going to get this right, but Warren Buffett, the rich dude, said, buy when people are fearful and sell when people are greedy, that kind of thing. So do the opposite. So right now, because people keep talking about rate. Like, I mean, I think not know what they're talking about, and they're not looking at the right figures and charts. But like right now, the people were there's a frenzy to buy the last 2 years. People were putting down huge deposits. In some area, like me in my area, North Carolina, there's due diligence, so there's non-refundable due diligence. So people are putting down tens and sometimes $100,000 more non-refundable to secure property because it's it's going out of style. People waiving home inspections, trying to waive appraisals, even when they know they're going to put themselves at risk. If the value maybe come in low, they may have an issue. Sight unseen, house comes on the market, put an offer in. I don't need to see it until later. We'll figure it out. So I think now, those people were kind of nuts a little bit, but that's the way the market was. You kind of had to. And what was I saying? But people were buying when the house values kept going up and up and up, and they kept overbidding and overbidding, and they really just wanted the house. So the price of the house didn't matter to them. And when you buy a house, the price is not going to change once you close. You're still going to owe that much money. Values increase, great, you have equity. Values come down, well, you're maybe upside down. That's just how it is. But with the mortgages, if the rates come down, you can always refinance, restructure, and save some money on the interest. But right now, you're not seeing such a huge frenzy in a lot of areas. Some areas you are. I'm seeing multiple counteroffers, but I think people that see housing as a long-term, a means to an end, or maybe see this time as opportunity, where they don't have to make a decision within minutes of a house going on the market. They don't have to put a huge deposit, waive all their inspection contingencies, things like that. And what's prevalent right now, and not all over, and of course subject to negotiation, is there are seller credits, which hasn't been seen in several years. Now, side note, you will see some price reductions, and to all the agents and buyers out there, and even sellers, I implore you to first reconsider price reductions and instead look at seller credits, because you can do a lot more with money as a credit to the buyer without changing the price as much, right? So $20,000 price reduction changes the buyer's monthly payment by like $100, right? And I think it changes their out of pocket like $2,000 or $3,000. But if you're to give them $20,000 seller credit, and they're not putting a big down payment, they could, with some of that money, buy out the mortgage insurance completely, right? Completely gone, no mortgage insurance. With a little bit more, they could pay pretty much all their closing costs. And with the rest, they can use that and maybe buy their rate down just a little bit. I don't recommend buying the rate down super low right now because rates are high. As long as it's affordable, I would say just kind of go middle of the road, and then get those gains when the market turns. But seller credits is one thing people are doing right now. So there's time for negotiation, time to do your due diligence, time to look at different houses and compare them in some areas. There are houses that are sitting 2-3 months and they're getting price reductions, and you could negotiate maybe a reduction and credit. Get the best of both worlds. It's not gonna be like it was when it was when sellers had to sell, where they were giving away cars. That was a thing for a while. In Los Angeles, giving away whatever. They give away more than they could just to get rid of the property, to get out from underneath it. So you're not gonna see that. So this has been a long ass video. I didn't think it would be this long, but I think it's important information to put things in perspective. Just looking past the noise. Don't look at the news because I looked at the on my phone. You could scroll up and there's like a news feed, and back to back, Goldman Sachs, home prices are going to drop 3%. The next article, a totally different source, home prices are 30% overvalued. It's just ridiculous. You'll see reports, rates climbing when maybe they go up like a fraction, an eighth, or maybe one day's a good day. Like rates, the lowest they've been, like incrementally and short-lived. So really, I think real estate professionals need to buckle down and really take the time now, since things are slow, is really look at numbers and see how you're best serving your sellers and your buyers, and how to really get those properties sold. Same with loan officers. Be a little more creative with what you're doing. And buyers, take the time to do your due diligence and look at the numbers and do some research and know what you can and can't do. Now's the time for working things out, negotiating, restructuring. How do you get the best of both worlds? How do you save money out of your own pocket at closing with credits? How do you minimize your monthly exposure, but also not coming into the table with too much to put yourself up for having to catch up to maybe a rate buy down when maybe rates could come down before you may see the benefit of that. And that's pretty much it. Another hot topic is 2-1 buy downs, but I think that's dumb. So I'm not even going to talk about it. But if you really want to know about it, I'll tell you about it. But reach out to me. But good luck, everyone. There's definitely opportunity right now, and just keep your eyes open. Keep it real. I need to get medicine.